You're listening to the Breakaway Wealth Podcast, the show that helps you build wealth faster, think outside the box, and break out of the herd. Here's your host, Jim Oliver.
Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, my special guest, Jacob Vanderslice. Jacob, welcome.
Great to be here, Jim. Before we started recording, we were comparing a bunch of notes on Denver. It turns out you were here for 20 years. That was a lot of fun.
Yeah, that was a lot of fun. And I'll tell you what, every time I talk to somebody from Denver, believe it or not, we talked about the brewery bar a little bit on First and Calumet, but I've actually had the lady that owns it now overnight me on dry ice, chili ranos and the green chili. So you cannot get green chili in Southwest Florida like in Denver. I'm just telling you.
That was worth the freight, I'm sure.
It was. I didn't even ask her what she charged me. Just send it.
Yeah. There you go.
And if I wouldn't be 300 pounds if I ate it every day, I think I'd eat it every other day. So Jacob, before we get started, introduce everybody to yourself, or introduce yourself to everybody.
Allow myself to introduce myself.
Yes.
Jacob Vanderslice. I'm a principal at VanWest Partners. We're a real estate investment company based out of Denver. We primarily focus on value-add self-storage. We own 41 self-storage facilities comprising just over 20,000 units, about 3.5 million square feet. Most of the deals that we target are existing facilities that are undermanaged. They've got below-market rents, above-market expense loads, and we add value by operating them more effectively. We'll occasionally do development projects, but those are kind of few and far between. We've got 90 employees, multiple different states, and we're looking forward to some interest rate relief.
I think that's coming, don't you?
I said probably early 24. By mid 25, it's going to be totally different, right? Silver is going to be down, the 10-year is going to be down. And here we are, and it's not getting any easier. We kept saying survive to 25.
Yeah.
And well into 25, here we are. And it's still a difficult market. So it's got to be coming. When and how, I have no idea.
That's if we knew that, then we could, we would be on an island somewhere, right?
That's right.
Because I would say the same thing. I would have said the same thing then, but I agree with you. It's coming. We won't go down a political rabbit hole, but there's some things that I think it's benefiting that are, there's a reason why it's not coming quite yet, but it's coming. It's coming. So,
Agreed.
All right, self-storage. It's funny when somebody gets interested in real estate investing and you start reading some books, you start educating yourself. If you don't know anything, sooner or later you come across self-storage, and you come across stories of people, like you just said, value add, right? I mean, value add works whether you're buying a business, whether you're buying, self-storage is a business. By the way, when I tell people, they say I'm a real estate investor. I said, you're in the real estate business. Because if you're a real estate investor, you're in the real estate business, right? So, but talk about how you got into self-storage, why you like self-storage, and then maybe give us just a little projection of the next 3 to 5 years, what you see happening in self-storage. Obviously, the interest rates affect things, but just kind of in the market itself.
Before I jump into that, let me jump into your comment about the real estate business. So we are, to a degree, a retail-facing consumer operating company before we're a private equity real estate investment company. It's operationally intensive. We have thousands of customers. I guarantee you right now, somewhere in one of our units, someone's breaking in and stealing something. Someone's cooking meth. There's a U-Haul backing into a gate. There's a homeless guy sleeping in a building somewhere. There's always something going wrong. So the operational excellence component to self-storage or any other real estate business is just critical. We got into the self-storage business back in 2015, and I've been a full-time real estate entrepreneur since 2006. And for many years leading up to 15, we primarily did fix and flips. We've done 1,300 of them all over the country, mainly in Denver, but we were set up in a lot of different markets. We started doing commercial deals in 13 and 14, kind of adaptive reuse retail. It's like taking cool old buildings in downtown Denver and repositioning them in a multi-tenant experience-based retail. Did some town developments, multifamily. We looked at self-storage for a while because we liked the fact that it was historically downside protected, durable recurring revenue streams, granular revenue streams. And we wanted to shift our business model to being less transactional. In retrospect, we were kind of buying and selling too often and too quickly. And that generates cash, but it doesn't generate wealth. And we thought self-storage was a good vehicle to have a more long-term hold thesis, responsible financing, enjoy the cash flow, enjoy the tax benefits, and eventually monetize that when it's appropriate. So we did our first deal in 15. It was a development project in downtown Denver. And went okay, so we did some more. And over time, we evolved to being pretty much exclusively a self-storage owner-operator. Couple reasons we like it, beyond the downside protection historically. We like the granularity of the revenue stream. So we're relying on thousands of customers to pay us $30 to $300 a month. So we're not beholden to one large user. And if that one large user, say like in a large industrial single tenant deal, if they roll over on you, it's going to take you a long time and cost you a lot of money to find a new tenant. If one of our customers rolls over, we auction the contents, clean the unit, and hopefully put someone there who's going to pay. We also like the dynamic revenue management aspect of the business. We can respond real time to supply and demand changes because all of our leases are month to month. So if we have a unit type that's full, we can raise rents with a 30-day notice, and we do those rent increases while trying to balance physical occupancy. And likewise, if we have a unit type that's lighter on occupancy, we can drop rents below market and start to fill those up. The downside of self-storage, I should say that the main risks of the asset class, beyond your typical real estate risks like cap rates, interest rates, incomes, population growth or declines, your main risk in self-storage is supply. Self-storage is really a 5-mile business. We track and we care what's happening, for example, in Denver Metro, but we care a lot more about what's happening within 3 to 5 miles of our development project in Southeast Denver. So if someone builds a new facility very close to you, which you can objectively defend against, subjectively defend against, but you really can't stop somebody from building a 100,000 footer in 2 years, a mile away. When you get supply shock, that's when you see declines in rental rates, declines in occupancy. That's really the risk. And every market goes through supply shock cycles. A bunch of people build at the same time because rents have gone up. Then rents go down because of that hyper supply. Eventually, developers stop building and those units fill up, and then kind of rinse and repeat the cycle. So your main risk is supply. But beyond that, historically, if you look at all the major real estate asset classes, multifamily, industrial, office obviously has taken a beating. Self-storage has been pretty resilient, both in good times and bad. As far as my outlook for the future over the next however many years, 3 to 5 years, first of all, my forward-looking statements are always wrong. I get a 50-50, and generally I pick the wrong one. But the theme in storage the last couple of years has been a moderation in consumer demand. And I think the big reason for that, among others, is a lack of transaction volume in the single family market. People bought a house 3 or 4 years ago. They financed it 3%. They've seen a big run up in value, but they don't want to sell because they're going to pay a lot of money for the new deal. They're going to finance the new deal to 6.5%. So what are they doing? They're HELOCing, they're doing the kitchen, they're doing an addition. They're generally not moving nearly as much as they were a while ago. And mobility and people moving is a big demand driver for storage. That's kind of suppressed demand. But we're seeing positive velocity, not only in our portfolio, but the REIT performance that we're seeing, that maybe the bottom was sort of Q4, maybe early Q1 of this year. And another part of the story that we like kind of going forward is we expect new deliveries and new supply to be continually muted. And reasons for that might be obvious, but elevated land costs, development financing is extremely expensive. It's low leverage, and hard costs remain elevated too. Steel is expensive, construction, labor, more expensive than it's ever been. So it's really tough to find a deal that's going to pencil and hit a risk-adjusted return on the development side. So that's kind of the macro reason why new starts are declining and hopefully continue to. And if you own existing facilities or you're targeting buying existing facility, that tells a good story for retaining your occupancy because of that kind of perceived lack of competition. Beyond that, if we see some interest rate relief, we could see transaction volume start to increase a bit more. But the theme for the last 2 years has been a lot of money that wants to be in a business, very few deals to buy, and very few sellers that will take pricing that buyers want to pay today, given the financing, how much it's changed. So transaction volume's been down, but I think the fundamentals are starting to look a little stronger than they were last year. We'll see.
No, I love that. Somebody told me one time, storage, no water and no tenants, which is the biggest pain in the butt for most normal multifamily real estate, right? I mean, I know no tenants living there, right? The tenants probably are a pain in the butt.
Yeah, they're not supposed to be living there, but sometimes we turn into multifamily operators when we don't expect it. But
That's right.
yeah, in theory, I mean, a storage facility of 800 units, you've got one bathroom and like a break room for the staff. And the 800 apartment building, you got 800 kitchens and maybe 1,200 bathrooms. A lot of stuff can break, a lot of plumbing. With that being said, I return to what I said a few minutes ago. It is still operationally intensive. There's a lot to think about.
So that's the thing that I like about, there's a lot of people in the listening audience that they do infinite banking. So they have this money sitting in an insurance contract. And because it's sitting there, they can use the insurance company's money at 4 or 5%. Some of them are higher, but I mean, there's a lot of them out there still 4 or 5%. And then they can go give that money to somebody like you. They buy a cash flowing asset. If there's any cash flow or in growth, then they don't need it. They just keep turning it over and over and over again. And what I try to tell people is that if you just do that and you don't take any of the profit, you don't take any of the cash flow, you just keep reinvesting it, it doesn't take as long as you think before you have a lot of asset there and a lot of cash flow. And you said something important is Dan Sullivan's one of my favorite coaches, and he says who not how, right? He has a book called Who Not How. So again, in my life, one of the things that's really helped me is finding people that have already figured it out. Like, I don't really want to be the storage expert, right? So would I buy a storage facility? Sure. Show me one that's making a lot of money and I'm in. But if I want to, when I have money sitting there and I want to invest passively, I tell every one of my clients and everybody in the audience, find somebody who you click with and find somebody who's doing what you want to do. And then you're basically partnering with them. You're providing the capital, they're providing the expertise and the operational expertise. And it's great. And you just keep doing that over and over again and diversify and so talk about, like, in your, just again, since 2006 in the real estate business, maybe one of the worst deals that you've seen or one of the best deals that you've seen as far as just, again, when I ask you for the worst deal, it's we learn from our worst deals, right? Like, oh my gosh, what could I have done differently? So maybe the best deal doesn't really matter because that's kind of pie in the sky. Let's just go the worst deal and then what you learned from that deal.
So I think we have identical sentiment on this line of questioning. So let me first say that the home runs are often unexpected, right? And no doubt there's a degree of operational excellence and execution that needs to happen. We've had so many deals, though, that we just sold at the right time. And yeah, we grew NOI, we did a good job executing, but we're like, oh, let's sell this thing like in early 22, like right before the run up in interest rates. And it was a home run. We didn't know what was going to happen. And we forget those successes quickly. And we remember the failures like they were yesterday. And the failures are how you learn. I've never learned anything from doing a great deal with a home run return. I've only learned from failing. And I guess two that come to mind, one storage deal and one that wasn't. We many years ago, we had an idea back in our single family days that we could build single family homes out of shipping containers. We could do it in volume. We could do a bunch of these. We could do them faster and cheaper than state building. And we did one, and it turns out it took us twice as long to do and cost us more money than it would have cost just to stick build it. And we lost like 300 grand. And all that we learned on that was don't do that again. Don't build a house out of containers. I'm sure lots of people have figured out how to do that in volume, but we were entrepreneurial and wanted to experiment, just didn't work out. One of the worst storage deals that we've round tripped. I think everyone listening probably has a basic idea of what a 1031 exchange is. You sell a deal, you defer the gain, you find a replacement property, you lock up that gain deferral in the new deal, and you kind of do that in perpetuity. Well, we had a 1031, so to speak, gun to our head, and we had a big tax bill. It was a second generation exchange. We did not want to bust our exchange, and we bought a storage facility in Ankeny, Iowa. And it's not a bad market. The storage facility was in bad shape. We knew we were paying too much for it. We weren't seeing a great story for revenue growth on it, but it was the only thing we identified. So we parked our money in that thing, and it underperformed, and we sold it for a nominal loss about 3 years later and ended up paying the taxes anyway that we would have paid had we not bought it. And what did we learn from that? Don't let the 1031 tail wag the dog. 1031s can make you buy deals that you otherwise will not organically or unilaterally buy if you didn't have that pressure. So forcing deals sometimes, whether it's an exchange or something else, is never a good idea. We knew it was thin when we bought it. Big surprise, it turned out to be more thin than expected. And we'll remember that.
It's funny that you say that, because I had a friend move from California where they had a ton of multifamily real estate. They moved to Florida and they just started buying everything up. And I was like, because they wanted the 1031, right? They were like here, and I thought, gosh, I don't know that it's really smart to have this much concentration in timing to this point in the market. And it was not for them. I mean, they're going to be fine. They have plenty, but overall, it's going to take them 5 years probably to recover from that. And if you really probably did the math, it wasn't worth it, right?
Yeah.
And the other thing that I think about with 1031 is when you have partners. So I bought like 6 small houses down in Naples one time. This is 10, 15 years ago. And I went in with 3 people, one a realtor, and they didn't, so I have 2 partners. One wants to do 1031, one doesn't want to do 1031, and it's just a pain. So, having, again, that goes back to your operational expertise a little bit, it's like not having different people and different people that are experts in your partnership trying to do it, having somebody run it, has a track record, knows what they're doing. I mean, it's not rocket science, right? I mean, it's the numbers make sense, the tax returns make sense, the P&Ls make sense, or they don't. And you see the value add. The value add isn't really in question, right? And I love what you said about you don't have to wait a year to raise rents. You don't have to do, like all of those things that people do in the, the Burr method. There's you have opportunity to not only do quicker but more efficiently, and really probably more upside in the threat you already addressed, which is somebody coming in. In Florida, we don't have basements, right? And a lot of people are condo people, so they're living in these condos, and if they live here for 5 years, people just seem to accumulate stuff, right? And I think everybody that lives in these condos that are in my neighborhood, they have a storage unit somewhere around here, and you see them popping up all over the place. So that's where I see that competition. But like, I think if you go 30 miles inland away from the coast in these small towns, I think there's opportunity out there in the middle of Florida. And they're really not operating them in the way that you're talking about. The old story of the people are turning in checks and stuff like that. They're not auto pay, or there's an attendant, and all these kinds of things, how to make it more efficient. But talk about like what if somebody. So first of all, like, give me just kind of the parameters. Like, what's the minimum for somebody to work with you? And then I know we're not guaranteeing, performance or returns, but what are some, historically typical returns that somebody could expect? Just kind of give me a little rundown of that.
Yeah. First of all, our models are always wrong.
Yeah.
The deal never goes like the spreadsheet says. Well, generally we're wrong in the right way. Sometimes we're wrong in the wrong way. There's two metrics that people typically use to describe the return target a given private equity real estate investment, or any investment for that matter. One is a term which I'm sure everybody's heard of, is IRR, or internal rate of return. IRR is purely a time-weighted return based on a series of cash flows. So IRR accounts for time. The second return metric is called multiple, or equity multiple, or multiple on invested capital. That's purely how much profit are you targeted to realize as a percentage of the original money you invested. And that's expressed in X's. So if you put $1 million in, you get 2 million out, that's a 2X. If you put $1 million in and $1.5 million out, it's a 1.5. So we typically express our return targets through the lens of IRR, which accounts for time. It's almost like an annualized return, and multiple. So we generally target returns in the mid-teens IRR range and around a 2X multiple over a 5-year hold. So that's roughly kind of what we're seeing out there in the market. Now, if someone doesn't like that return, we can just get in our spreadsheet and just fix a few things. It'll turn into a 20% IRR and a 2.5X, right? You got to believe what you put into your model, and you got to believe you can execute to it. Historically, people ask about track record, and I can't tell you how many pitch decks I see of all the crazy returns that a given sponsor put up in 2021, right? Or early 2022. And that's great. They know what they're doing probably, but everybody was doing those same returns. You could not lose unless you were just a complete moron or you were a criminal. So what I think matters more is track record into this new higher interest rate cycle. Show me what you've done since mid to late 22. Show me your round trips. Show me your asset performance. It doesn't matter to a degree, really anything before that, because the market was so different. So historically, we have, in the new kind of cycle, we've sold 5 deals. Of those 5, 4 of them materially outperformed our return targets from an IRR and from a multiple perspective. One of them materially underperformed. And then again, these are the ones you always remember. It was a deal on the Florida Panhandle, single asset syndication. We were targeting a 20-something IRR and bought it cheap price per square foot. We got cheap debt on it. And our plan was to grow NOI over time, refinance, and kind of pull some cash out and hold on for a while. And we saw revenue growth just kind of peter out. Some new supply came online, and we're like, we don't see line of sight to this improving anytime soon. So let's sell it for a small profit. Instead of doing a 20-something IRR, we did a 7. And a 7 is not a terrible return, but certainly not what we targeted. So again, deals never go according to plan. Sometimes they exceed your expectations, and sometimes they underperform your expectations. And hopefully the latter is the unique outcome, and more often than not, they exceed. But that's roughly what we've done so far, and kind of at least in the recent cycle. And current deals that we're doing, generally mid-teens IRRs around a 2X multiple. As far as minimums go, we have a minimum of 100,000. We have investors all the way from multi-billion-dollar pension funds, all the way down to just an entrepreneur who's got a $100,000 self-directed IRA, and kind of everywhere in between. So wide investor demographic.
I love that. I used to tell people for 15 years in Denver, I built a financial planning practice, and my people were all the people down off of Santa Fe, all the the blue collar millionaires is what I would call them. Is they're running welding shop, plastic formations companies, etc. None of the financial babysitters, financial planners really go down there because they want to go. Back then, you had to have the right tie, and you had to have the right suit, and the right shoes, and the right watch, and I was like, gosh, I'm just not having. I was 22 years old. I wasn't having success there, so I went into this blue collar area, and these people started telling me everything I would ever want to know, and they were glad to talk to me. And I learned about business because it was this little business and this little business and this little business. And I learned the good things, the bad things. But what I loved is I got away from doing the financial planning thing because of exactly what you said. Is I would say, okay, you need this lump sum of money, because this is how we were trained, right? Is you you work hard, you save your money, and then you build up this nest egg at some point in time. Then you live off of that for the rest of your life, and you hope you don't live too long before your money runs out. You hope you die sooner than your money runs out. Well, that doesn't seem like a very good strategy, right? So and if I said, okay, you just have to save 10 grand a month to hit your goals, and they go, well, I don't have 10 grand a month to save. I said, okay, let me change inflation, change your rate of return, change this. Oh, look, it's only 5,000. Oh, I can do 5,000. And so it's the same thing. I tell everybody all those projections are wrong. And really what matters is if I had $5 million of cash flow coming in every year from my investments, I wouldn't care what I had in the bank. I wouldn't care what I had in I don't even want to say 401k, but I wouldn't care about any of those qualified government plans. But you said something, because if I'm sitting there with money in my infinite banking system, that I know that I can borrow interest only at 4 or 5%. And I can participate in self-storage at mid-teens, 2x in 5 years, whatever. Anything around that, I win. Even your 7% deal, I wouldn't lose.
Yep.
Right? I mean, I still would win. I mean, it's, like I tell people, like the batting averages aren't based on one at bat, right? So like you better not have just one at bat, because you're either going to feast or famine. But like over 100 at bats, 1,000 at bats. And so, all right. So Jacob, how do people get a hold of you? What's the best way?
So, one last, I got to throw this one thought here. So if you're considering arbitraging your whole life plan into private real estate, whether it's with us or somebody else, one of the most important things you can consider is getting to know the sponsor and asking them the hard questions. Don't tell me about how much money I'm going to make with you. Tell me all the ways I can lose my money. What has to happen in your deal or your fund that would cause me to experience a loss of capital? And then furthermore, sure, tell me about your home runs, but spend a lot more time telling me about your failures. What's the worst deal you own right now? Give me an example. Why isn't it performing? Why is it the worst deal? What happened? Was it financing? Was it aggressive underwriting? But if you're deploying capital into private real estate vehicles, whether it's self-storage, multifamily, a private debt fund, you are betting, whether you know it or not, on the investment manager as much as you are on their platform and their asset class, because people are what are going to help you navigate challenges. And the trust in that person and that company and those sponsors is critical to establish before you wire somebody a couple $100,000. So just things to think about. Don't be afraid to ask the hard questions. And if they're not giving you answers to the hard questions, they're probably not someone you want to work with.
That's a great point, Jacob. I just wrote a new book. It's called Owner Shift, and it's really like running your life like an owner, not a consumer or a customer. And part of doing that is shifting that mindset to where you're responsible. So, like you said, if you go to Jacob's website and you think, hey, this is pretty interesting, create questions. Ask every question that you can ask, and check out every resource that you can check out. And if there's YouTube videos I do all of that stuff, and I make notes, and I write down questions. Even when I read a book, I write down questions while I'm reading. And I reach out to the author, and you'd be surprised. Every single author almost gives me the answer. And the ones that don't, I always think, maybe they really don't know this, right? Maybe they really don't know how to do this. The ones that say, here, let me give you exactly the answer of the question that you asked. So I love that. I love that attitude. So how do people find you?
I love to talk shop about real estate. People could email me, jacob@vanwestpartners.com, hit me on LinkedIn, Jacob Vanderslice, or go to our website, vanwestpartners.com.
Perfect. All right, Jacob, as we wrap up, I got 2 questions for you. The first question is, throughout your success in real estate, life, being lucky enough to you probably don't even notice the mountains. I didn't after a while, but living in a beautiful place like Denver, what's the best advice that anybody's ever given you?
In a few words, take a risk. Yeah. There is no investment that is completely downside protected. You can read all the books, go to the seminars, listen to the podcast, but the best way to learn is to take action and take a risk. Protect the risk, protect the downside, But wealth creation takes time. And if you're not in the game and you're not deploying into whatever vehicle you want to deploy into or consider deploying into, you're missing out on that time component. So take a risk, a quantified and a downside protected risk, but take a risk.
I love that. I mean, without giving names, I was looking at expanding one of the businesses that I'm involved in, and my partner was very sheepish, and I was like, "Whoa!" Like, it was surprising, right? Because I'm always like, "Yeah, if we can buy it at the right terms, let's expand," right? Like, why wouldn't we always expand, right? We're all like always. Yes, it's a risk, but like you said, it's a calculated risk. We have the P&Ls, we have the tax returns, we have the bank statements, we have like everything that we could want. If there's a question on there, ask me the question. But I'm always like, how do we get that deal done? Not like, oh, I'm afraid of that deal. And I know that that's probably happened to you too. Is it's like when you want somebody that can take action and is okay with the risk. Like you said, we're going to lose some, and it's just it's minimizing the loss, right?
Exactly.
All right. So last question: if God came down from heaven, Jacob, and only allowed you to retain the knowledge that you've received from one book, what would that book be?
So you gave me this little cheat question in the very beginning, and in the back of my mind, I've been considering how I was going to answer it. So I am not a great business book reader. I've read all the big ones, but I just have a hard time getting through them. What I am is I'm a voracious reader of historic nonfiction, especially leadership books. And the author that's had some of the biggest impact on me is a guy named Ron Chernow. He's a fairly famous historian. He wrote the Alexander Hamilton biography that they kind of made the play off of. He wrote a book about Washington called Washington a Life. And I'm currently reading his biography about Mark Twain. These are heavy reads. But the knowledge within these books about leadership, overcoming challenges, the history of our country, some of the one-liners, some of the quotes from all three of these major historical figures is just infinitely valuable. And if I could memorize every word of those and apply it to my kind of daily existence, I would be in a better place than I am now. So unfortunately, I get little snippets in my mind. I've read them all, at least the first two twice. This started Mark Twain, but Ron Chernow books are inspiration.
I love it. One book that and if you have kids, the one book that when you talk about historic, and it's a different genre, but there's a book called Letters to My Son by J.D. Rockefeller, 38 Letters to My Son. And it's basically the richest man in the world around between like 1895 and 1913, something like that.
Yep.
Is if you think about, he's not just sending his son a text when and talking to him on the phone, and everything. He's writing him letters, giving him advice. Oh, this happened to you. You lost $1 million in the stock market. This is how you recover. He has one in there, and he says the biggest hindrance to me becoming the richest man in the world from nothing, right? He grew up very poor, so it wasn't like he was given anything, is the banks. And he said, but now I am the bank, right? And so I tell people that from an infinite banking perspective. But if you think about it, you're getting there's actually 40 letters because there's 2 bonus letters in the back, but you're getting 40 letters, advice to your son, to his son that obviously he loved and cared about. Like, here's what you got to do, son, to be where I'm at, right? And I think that's as valuable as anything else that you can read. So I love that you like the historical figure, because it teaches you who, not how. It teaches you, like, what did they go through and what struggles and decisions. And, sometimes you're in awe of some of the decisions that people made or the risks that they took, right? And they talk about their failures because, everybody thinks, there's lots of famous examples of this, but like everybody thinks, oh, they just had this success. It's like, it's never the story. Never. It's a grind. My boys are 5 and 7.
by the time they're old enough to understand it, I hope that I'm in a position to write them letters like that.
I love it.
I got some work to do. But I'm working on it.
That's great. You're making progress. Progress
That's
makes
right.
us happy, man. I mean, whether we're trying to get in shape, whether we're trying to lose weight, we're trying to eat healthier, whatever it is, because I believe that health and wealth go hand in hand, and it's progress. Every day you lift weights, you're a little stronger. Great. You get on the scale, you're a little lighter. If that's your goal, then great. So
Jim, forgive the plug, but the fact that you look the way you do, which is good, and you're 60, means that you're living what you're preaching, sir. Well done.
Thank you very much. I figured out a long time ago that look, you're in Denver, right? People are healthy in Denver. It's one of the healthiest areas because people are active, and there's 300 days of sunshine a year, and people are outside and they're enjoying that. And I tell people I feel as good at 60 as I did when I was 35. I mean, and there's no BS about that. And can I lift what I did when I was 35? I can't, but still I can still. So I tell people, you're not going to get older. In fact, I don't want to go down this rabbit hole, Jacob, because I will. But this friend of mine who's in his 80s, he does this thing called a DexaFit, which is a scan. It's a medical scan of your body, and it gives you a biological age. He's in his 80s, and his biological age is going down, and his biological age is lower than his son's.
How about that? Wow.
I mean, that's inspiring, right? Because you think, I'm like in my 80s, I'm not going to be able to do anything. Guy plays tennis 6 days a week. I mean, it's like, yes, you can, but if you believe everything that you hear in the news and everything that mainstream medical, food, everything else would tell you, well, then you'll probably die in your 80s.
Something to aspire towards there. Absolutely.
Yeah, absolutely. Well, thank you, Jacob, so much for being on the show. Really enjoyed it. And audience, I would encourage you to reach out to Jacob, and we're going to put all this stuff in the show notes, but go and connect on LinkedIn and see if this is for you. Because again, those rates of returns sound great. The exit factor sounds great. Especially if you're using your infinite banking system for it. So again, thank you, Jacob. Now you made me really hungry for brewery bar since it's 1:00 here. Audience, we're going to wrap this up like we always do with the incredible words of Earl Nightingale and the strangest secret. Take it away, Earl.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Thanks for listening to the Breakaway Wealth Podcast. Be sure to subscribe to this show wherever you're listening so you never miss an episode. If you want to start increasing your wealth building ability right now, go to community.createtailwind.com to join our free online community and get access to free, in-depth training designed to help you build real, lasting wealth. See you next week.